All right, folks, welcome to the show today. And today I'm very lucky to have Jay Wolberg on for an interview from tradingvolatility.net and elsewhere in the volatility sphere. So, welcome, Jay, to the show.
Hi, David. Thanks for having me.
You're very welcome. That's a little bit better than starting talking about teeth, I guess.
Yes, that's a proper introduction. We won't have to talk about teeth today. We can focus on volatility instead.
Excellent. Well, I know that this is it's an interesting spot to talk about shorting volatility because it's kind of a paradoxical spot because if you just look down the surface of things, we're kind of low in the VIX range right now, and so intuitively, if you were just coming to this, you'd say, well, I don't want to short the VIX; it's so low in the range. But as you and I know, there's a lot more to it than just where the VIX is right now.
Yeah, and I think you look at, where a lot of people look at where we are at the current cycle. We've had this huge run up in the S&P 500, and we're sort of trading sideways. It seems like we're all just waiting on earnings season, which kicks off next week. And I don't know when you will air this, but it is Thursday, April 4th, midday, and there is essentially nothing happening in the market. Very similar to what we've seen in the past couple of days. But you're right. VIX is low, and I think many of your listeners may know short volatility is primarily done through buying a fund, either SVXY or shorting VXX, and those funds rely on VIX futures. So what we really want to take a look at is where VIX futures are in relation to VIX. And there's a couple of things I'd love to look at, and we can talk about that in detail. But I got to be honest, this short VIX trade lately has been sort of a struggle. It just seems like anytime it really gets any sort of momentum, it just gets shut down with a volatility spike. And with my risk controls, I'm often forced to close out those shorts just to protect my capital.
Yeah,
So
I mean,
yeah, it's a little bit of a tough spot.
yeah, it seems like nothing's really been the same since the Volmageddon and all that. Where it seems like we're constantly sort of waiting for stuff to get back to normal, but there's been a series of other mini to major spikes since that February 2018 event that have kind of spooked a lot of people, I think.
Yeah, yeah, I am certainly one of those people. It makes me a little bit nervous to short volatility, and I I think the best approach is to stick to a process and trade that process. And at some point, maybe as an investor, you decide you just want to take your ball and go home and maybe take a break from the market. And I think that is a fair conclusion to reach for some people. Um, I think a lot of people are sort of better off maybe just um, thinking long term and looking at index funds. Um, but I do think if you have the ability to monitor the market every day and watch your positions, I think there's money in shorting volatility or being long volatility for that matter. Um, and this past year is just, I think it's been a grind for a lot of people emotionally. Just hard to keep up with the daily swings, and some of that's news driven, and sometimes that's um, we saw the emerging markets sell off last year, late last year after uh, some of the worries about the rate hikes. But yeah, there's a lot of factors at play.
So let me just ask you, just to back up for a second, and how did you arrive at this point as being a sort of an expert in volatility? Were you into the stock market and whatnot when you were younger?
Yeah, I think from a time maybe 8 years old, I remember going on family vacation. I was on the plane with my parents, and I wanted to ask some guy in business class if I could borrow his Wall Street Journal so I could look at the day's gains losses. I'm in my 40s, so back then people had newspapers, and that's how we figured out um, what happened in the stock market. So that was sort of a different world. Um, but then I lost that that hobby, and I pursued school. I did some engineering work, and I got back into it in about 2009, and started doing day trading. Started looking at VXX, and just thought that was an amazingly bad product, and I just wanted to short it. And that was all great until 2010, when VXX had a pretty large spike. I believe it was sometimes mid-year in May, I think, and I had to take a step back and wonder why this sure thing that has been a really good fund to short was suddenly making big gains. And at that point, I sort of dug into the prospectus and actually found out, hey, this thing is driven by month 1 and month 2 futures. And the contango and backwardation has a large impact on how the fund behaves. So I sort of took those learnings, and I saw a lot of people on the internet that were really confused about how VXX worked, particularly on the long side. I think even the founder of the VIX, or the father of the VIX, has said that he lost quite a bit of money on VXX. And that sort of struck me as a sort of an aha moment, that there's some messaging that I needed to get out. People need to understand how VXX works. And then after XIV came along in 2010, how does XIV work?
Well, we've sort of entered a new world now with VXX sort of expiring, and everybody's switching to sort of VXXB. Those are both pretty much the same thing, right? VXX and VXXB?
Yeah, for the most part, they're identical. Okay. I will probably continue to say VXX only because VXXB is just a mouthful, and when I write it down, it looks like a typo. So VXX is what I'm going to go with for now. But yes, the VXXB is essentially the same thing.
So, so how did you get from being sort of an enthusiast and trading, doing some trades for yourself in these volatility products, to having a presence online? And I noticed you have strategies that you market to people. How did that process come about for you?
I started with a blog that was just sort of some informational talking points about what I was doing with my trades. And I realized people wanted something that was more, they wanted to know more. They wanted to see the math behind it. So part of it was I wanted to write about it and teach people. Part of it was I was updating these spreadsheets every single day manually with the closing VIX futures data, and as well as the S&P 500, and just an enormous spreadsheet. And I got tired of doing that manually, so I found a way to automate it and post it online so that I could just look at the website myself. So essentially, I was solving my own problem, and I found that other people just found we're looking for a way to look at VIX futures. And if we talk about the dates here, I launched this in 2013. Okay. And back then, there was really no way to look at VIX futures data online. TD Ameritrade wasn't carrying it. Most of the brokers weren't carrying VIX futures data. And I think VIX Central was up by then. I can't recall when he launched his site. But there was really sort of an absence of the values of the VIX futures. And then I also wanted to post a whole bunch of other metrics, again, trying to perhaps solve my own problem. For example, I'm looking at the weighted value of month 1 and month 2 futures. I look at ratios of VIX to the 3-month VIX. I'm looking at the ratio of month 1 VIX futures to VIX. And then also I look at VIX to actual volatility. So all these things I sort of track on my site, just so I have one page that I can look at.
I got you.
So that's sort of the data part. And at some point I was on Twitter, and still am on Twitter, and I launched a sort of an informal poll and asked if people would be interested in a subscription service, and there was a lot of interest. So I put something together, which I still offer today, which consists of automated signals at the end of the day for basically for buy or sell of those VIX ETFs.
So what is VRB?
VRB, I think VRP.
Oh, VRP. I mean, sorry, VRP.
Yeah.
Sorry.
So that's the volatility risk premium. Essentially, a measure of the implied volatility that we look at, that the VIX quote, versus the actual volatility. And the actual volatility is essentially a measure of the standard deviation of the S&P 500 over however many days you want to look at it. I guess in another way of saying that, in more simpler terms, is how wild is the daily close difference in the S&P 500. Essentially, if every single day has about the same percent change, it's going to be a very low actual volatility, versus something that we saw in maybe December, where we are down 2% one day and we're up 2, 3, 4, 5% the next day. That's going to result in a very large actual volatility.
So if the closes are moving around more and more, then VRP number would be higher. Is that the way it works?
Well, so yes, you've got, it's basically VIX minus the actual volatility.
Okay.
And you can also divide by it. It's sort of always, it's a comparison between the two.
Okay.
So you're looking at which one, is VIX relatively expensive or cheap compared to the actual volatility that the market has seen.
Okay. And so,
and that's,
yeah, I'm sorry, go ahead.
So that's one of the things I look at. It's sort of a secondary indicator.
Okay.
I have two indicators, and VRP is one of them. The other one is actually looking at VIX futures, and it's one that I actually prefer to focus on, and probably makes more sense to talk about that one.
Okay.
Because it's looking at the underlying drivers of VXXB as well as SVXY, which is the VIX futures. So, I think you talk about this quite a bit as well, maybe on your show, and also on Twitter, I've noticed, looking at the contango and backwardation.
Yes.
So this is a really good thing to look at for most traders, with the exception of people that are day trading. I think if people are day trading, contango and backwardation are almost irrelevant. You probably need to look at something like auction theory or pivot points or some other day trading tool that's focused on the month 1 and month 2 futures. But generally, if you're doing swing trades, and I think most people prefer to do swing trades, it's a little bit easier to handle for the intermediate trader, I'd say. Mm-hmm. And that's what I prefer to look at for the swing trades, is at month 1, month 2 futures. And specifically, I don't know if you'll ever look at or talk about the weighted value of month 1 and month 2 futures.
Okay. So you mean how much they are each contributing to the ETPs at that moment? Is that what you mean?
Yeah, exactly. So every single day, the weighted value changes. It shifts a little bit from month 1 to month 2 weightings as we approach the expiration date for VIX futures. And you can run a calculation, basically take the weight of month 1, and today it's 43% April. Multiply that by the April quote, which is essentially about 15 right now, and the May component is about 57% of VXXB, and that's trading around 16. So you add that together, you get a weighted value of about 15.6 as of right now. Okay. And one of the things I really like to look at is what that weighted value looks like over time. And if I am short volatility, I want to see that decline as a general trend. I don't mind to see spikes every now and then, but if it's flat, if it's sort of bouncing off of a low, then I want to be really careful. And unfortunately, we don't have any graphics. I don't have anything I can point to specifically, but on my website there's a graph that shows this historical weighted value, and we can kind of see that the bottom has been around 14.8 over the past couple months. So we're sitting here around 15.6. There's still a little bit of room for that to fall, but the trend over the past week or so has been sort of sideways and is actually bending a little bit upwards. So it makes me a little bit nervous in terms of shorting volatility at this point. Mm-hmm. So unless that changes, turns around, it's one of those things I'll probably have to close out the short vol position because that momentum just isn't there.
Yeah, it's interesting because, there's different ways of looking at it. I also like to look at it as far as a potential, and by potential, what I do is I look at the difference between where the spot is and where the futures are right now, and that distance I sort of see as a potential amount of sort of money you can make as the futures slowly fall towards the spot.
Yep.
And now that potential is not always realized, and there's things like momentum or just random events in the market that can throw that stuff out of whack. But if no potential is there, then there's no interest in really putting the trade on right at that moment. But it also, that's like isolating the situation, all things being equal in vol. But as we know, the VIX is moving around all the time, and so you really can't isolate just the shape of the term structure from like other events in the market that could move volatility.
Yeah, no, that's right on, and that's a really good point. If we look at the weighted value compared to VIX, there's this premium of looks like about 13% right now of the weighted VIX futures over spot VIX.
Okay.
So huge potential as of right now. And that's actually a really good thing to look at and to trade off of. And you're right, it's good as long as that contango is sort of consistent to be useful. And obviously anything can happen in the market, but we've actually seen very long periods of time where VIX just stays very low, kind of bounces between a low range. And if we look at charts, you can see times where it just, maybe it spends a lot of time between 14 and 12. It doesn't really move much, much higher than 14. Maybe for a day or two it might, and you just watch the VIX futures just decline and approach spot VIX, and that's where a lot of those good short vol gains are made. So yeah, it's great to see a potential, and I think it's just that shock of VIX jumping that sort of throws that all out the window.
Yeah, it seems like every time we reach a high in contango, like, oh wow, you look and sometimes it does happen right before expiration, but let's say it's not right before expiration and you get contango's over 10%. It seems like every time we get to one of those points, it gets ruined somehow. You know what I mean? It's like something happens, and it looks on paper like this is the perfect time to be short. And if certainly if it would stay at 10% over the next 3 months and nothing would happen, it would be great. But it seems like I personally don't consider contango or backwardation numbers any sort of future indicator of something that's going to happen in the future. I think it just describes what the shape is right now. It doesn't predict the future, but at the same time, every time it seems to get to an extreme, something seems to happen.
Yeah, 100%. I would probably add to that that the VIX futures structure sometimes can get a little bit oversold, just a little bit offsides, and yeah, it seems like the moment that you think you're going to have a good short setup, it just kind of collapses. So yeah, you need an exit plan, and I'd probably add to that, if you're trading these products, you have to be ready to take some losses on trades. And I know your background as a trader. I guess that applies to all trades, right?
Yeah,
You're
of
going to
course.
lose in this market.
Yep.
Yep.
So what do you think of the strategy of like basically spending most of the time on the sidelines and just waiting for that spike to come and then putting the short on once volatility has spiked, like it happened in December. Now we didn't know if it, we didn't know when it was going to come back down, but we knew that it wasn't going to stay that high for a while. But it takes a lot of patience, of course, to be on the sidelines. But you could have rode a nice downhill ride if you'd shorted volatility on during the spike in this December. Do you think that's a legitimate strategy to just be just hanging out in cash most of the time until actually something happens and then put the trade on?
Yeah, I think for me, it probably doesn't make sense. I am process driven and I want to stick to the process.
Mm-hmm.
All my entries and exits are systematic, and there are times when I just wish that I didn't have to make a trade. And sometimes I'm proven right, and I'm glad, or I'm upset that I had to make the trade. And then other times I think I'm going to be so wrong and short's going to be the worst thing to do, and it turns out well. So at least from my experience, it's hard to pick and choose. But on the flip side of that, I think if you are you have a full-time job, you have other priorities that you want to focus on in life. Waiting for those opportunities is probably a better way to go. You can kind of skip the daily mental taxation of how's my position doing and being worried about it. The trick is just going to be identifying what your entry signal is versus trying to go off a feel. But as an alternative, ZIV is something that's sort of not talked about very much, and I don't think it has a very high volume. For those of you who don't know what ZIV is, it's very similar to SVXY. It's a way to short VIX futures, but it shorts the months 4 through 7, which tend to move much more slowly in response to daily market moves. So from that respect, you can wait for a great opportunity like December. You can buy some ZIV to get some exposure to the VIX futures curve, but you don't have to worry about losing another 50% that you might have to worry about if you're shorting VXX and the wheels sort of fall off the market.
Yeah, and ZIV did okay in that Volmageddon thing too. I mean, it survived.
Yeah, it survived Volmageddon. It just has a reduced beta, so it doesn't gain as much, but it also doesn't lose as much. And that's a fund that I'm really surprised more people don't look at. The biggest drawback is the daily volume just really isn't quite there for any large size. So I can't really trade it, but it's a really good option, and it's they talk about risk reward a lot, but when you compare ZIV to even an XIV, which doesn't exist anymore, a lot of the time ZIV would have better annual returns than XIV because the drawdowns were much smaller. So you actually had less risk and you actually had better reward. And in the end, after the Volmageddon, I think that probably is doubly true, given that it survived and XIV didn't.
Yeah, I want to congratulate you on the amazing returns that your strategies have had. Those are really, really impressive. And I want to ask you if I'm somebody who wants to use your strategies, if you could just talk for a minute about how one would go about executing that day to day. So, like, let's say I have $10,000 and I want to, I've read some of your blogs, and I understand a little bit about the term structure, and I want to do. Let's do this. How would
Yep.
how would I go about doing that?
Yeah. So the returns have been good overall, and one of the things that I decided to implement back in, I guess it's 2016. I'm not looking at the web page right now, but I started having this tracked by a third party. So everything, my signals at the end of the day get sent to Collective 2, which is collective2.com. And I have two different strategies that I send my signals to there. And the way it works is at 3:57 each day, I'm looking at my indicators, and if there's a buy or sell or any sort of change, it sends a signal to the Collective 2 platform, and then Collective 2 will send buy sell messages to all my subscribers who are interested in this automated trading to execute in their individual accounts. So I find this to be the best way because people can turn it on. They don't have to do the trades manually, which as I talked about a little bit previously, there are losses. Sometimes there are back-to-back losses, and that gets really frustrating. And you can't trade a system if you can't follow the rules. So what this automation does is allow people to actually trade the process. So that's probably the best option. And the drawback is Collective 2 takes a pretty big cut of just to use their service. So I think they charge $99 per month for the automated trading portion. That all goes to them. Nothing goes to me. So I think probably with 10,000, it may or may not be worthwhile, even if we're generating our average of, I guess 80% per year. It's still probably a little bit steep. You probably maybe need 20 or 30,000 to dedicate to the strategy.
So if I understand it right, if somebody wanted to execute that strategy, they'd actually set up an account with that company who would automatically execute the trades every day or every time that your signals send it out, and it would cost $99 a month to do that or something. So like $1,200 a year or something.
Exactly. You can actually use your own. You have to use your own brokerage account. So You can use Interactive Brokers. They have a list of brokers that they go through, and some of them are preferred where you get better pricing on trades. And I think Interactive Brokers, in fact, is their preferred broker.
Gotcha.
So yeah, you just have your own account, and then you just connect the accounts, and you can stop at any time. You can choose to follow other strategies on Collective 2. There are some other good ones and some other volatility strategies that are actually pretty good. There's actually a lot of really bad strategies on Collective 2. So you have to watch out for those. But my idea was, since I started this in 2013, and I had some really good years, and all I had to show for it was hypothetical gains on a spreadsheet that I made. It's a tough sell, and it should be a tough sell to most people out there. Why would you want to subscribe to a service where some guy on a website says, "Hey, I returned 50% per year or 80% per year," or whatever that number is? It just sounds a little bit insane. So I thought that the best way was to have a third-party account, something to track all my automated signals, and that's basically why I chose Collective 2 to solve that problem.
Well, that's great. That is a really important thing, and I'm glad you brought that up, because there's so much, not only in this little VIX part, but in the rest of finance, of people claiming these returns and stuff, but they won't expose themselves to being audited. It's just kind of out there. And you're right. Smart investors will ask to see the proof. But there's this whole other category of people who, they're somewhat naive, or they're just starting out, and they're going to throw their money somewhere where somebody, hasn't been able to prove anything, and they get caught up in these, snake oil salesmen. And so to have, I have total respect for somebody who's willing to put out their results. It's like show me the proof. Everybody should be able to do that. I would think. Who wants to be taken seriously in this industry? And we're up against there's so many people in this industry, especially like on YouTube, that are hucksters, and so it's great to see somebody who's willing to expose themselves to being audited like that.
Yeah, yeah, it's a really tough environment to find what's good and what's not. And hopefully, with our interview, my goal here is really just to help people think about volatility in a different way that they maybe haven't before. I'm not necessarily looking for subscribers. I think that'd be fine. But just some of the topics that we could that we previously already covered. The term structure and what sort of drives the VIX ETFs is really more important in my mind. Just knowing how many people are out there trading these things and maybe not knowing exactly how they act or having all the tools that they may need.
Yeah, I know that one thing that we talked about privately for a second that I wanted to talk about was the situation when we arrive in backwardation. And some people think of like, well, contango and backwardation are two sides of a coin. And when we're in contango, that means everything's decaying lower, and you want to be short. And when we're in backwardation, everything's moving higher, and we want to be long. And the market just kind of determines which we're in at the time, and we have to take that signal and position ourselves accordingly. And you and I really kind of know that usually isn't true with backwardation, but maybe we should kind of sort of explain to people why that's the case.
Yeah. Backwardation is very, very powerful, especially if VIX can remain sort of elevated for any sort of period of time, weeks, preferably. We saw that most in 2010, 2011. Those are some examples of some more extended backwardation periods. We saw a little bit last year, and VXX saw the huge gains, especially Volmageddon in February, October and December to some extent as well. But yeah, that can be really strong, as every single day it's the opposite of contango, right? You've got a spot VIX that's much higher than the VIX futures, and the VIX futures are going to creep back up higher towards spot VIX every single day as long as it stays elevated. Mm-hmm. So you get sort of that negative roll yield, which is a huge upward push for VXX, and it's all it's consistent until the market sort of decides to reverse on a dime, equities rally, and VIX starts to fall hard. And that's sort of the trick of getting out of VXX alive with gains. And one of the things that we talked about last time was looking at the volatility of volatility, which is the VVIX. Mm-hmm. It's one thing that I've been looking at recently. Started looking at it after February last year, and it tends to be a really good signal to tell you when to get out of your VXX position. So if you don't know what VVIX is, you can check it out. It's pretty much available any brokerage, I imagine. You can't trade it. It's what it is. It's a measurement of the volatility of the VIX and of the implied volatility of the VIX. And a lot of people talk about VIX being the fear gauge. So if VIX is driving a lot higher, that means there's a lot of fear in the S&P 500. Well, I like to talk about VVIX as sort of the panic gauge. And if VVIX is high, that means people are very panicked about the VIX. They're panicked about the market. And as it starts to drop lower, it's sort of the absence of panic. So that's sort of the way that I like to think about it. And the way I like to trade with it is looking at it, the relative numbers over the past week or two. I don't really care about the absolute numbers. I don't care if it's 100 or 110, 140 or wherever it is today, 80 or so. It's more about the trend over the past 5 to 10 days. So, as we apply February learnings, October learnings, there was a pretty consistent message from VVIX as it plunged. The daily moving average sort of plunged below. I like to use something between a 5 and a 10 exponential moving average, and I think everybody's different, but that's sort of the signal that once the price of VVIX drops below that moving average, that VXX trade is essentially dead. It's low chances that it's going to recover, and the markets are probably going to rally from there.
You mean the long VIX trade is dead?
Yeah.
Time to get out. Yeah,
exactly.
I like to for me, when I think of VVIX, I think of order flow in the VIX options, and I like to try to dig in a little bit if I can to see. I'll go on a scanner to see large option orders in the VIX and try to see what option orders are driving that move if there's a move in the VVIX. And a lot of times there will be a big options trader too that I can point to. And you can do the same thing in the VIX by looking at SPX put orders if you wanted to. And it doesn't necessarily give you all that much information, but it can give you some information because there's a difference between somebody buying out of the money calls in the VIX, which to me would seem to be very bullish for volatility, or someone doing some sort of like 1x2 that trades at the money or different months. It means something different depending on what the actual orders are.
Yeah, and I don't look too much at that, but that can certainly give you an extra layer of knowledge. What kind of scanners do you use typically?
I generally just go to the site called barchart.com and look at the large order flow. I know that the SIBO has the live vol product that a lot of people use as well. It's interesting. This volatility view show on Options Insider Radio, they go through every week the top 10 biggest option trades and open interest in the VIX. And that can give you some insight as to what's going on because, there were some famous big trades, that 50-cent trader guy and others in the last couple years that were doing certain things. And, some of it's relevant, some of it isn't. But if I can get a little bit more information into what's moving these things, I try to. But yeah, I totally agree with you with the VVIX. It's more, for me, it's more of a function of a big move down, meaning that stuff is calming down than a move up. We did notice like a few weeks ago, someone was tweeting about it coming off the lows. It was like 80 and it got to 86, and then right after that, we had a little spike in volatility. Now, in that case, it kind of led everything, but that's not always the case. I think, it just kind of depends.
Yeah, I think there are certainly some days where VVIX will spike perhaps a day earlier than VIX, give you a little bit of heads up that there's some demand in VIX, in the VIX calls. But other times it's maybe just the same day as the VIX, so it doesn't have a ton of predictive power. But I was certainly a skeptic for a long time, and I am paying attention to VVIX now. Nice. It's not a sure thing. It's sort of a secondary indicator to me, but I do pay attention if that is rising ahead of VIX, or anything looks sort of unusual with it. And again, when it'll fall ahead of VIX also. That's probably the biggest usefulness there.
Yeah,
I found.
I feel like anytime we're in backwardation, what that means to me immediately is that we're in the midst of some sort of spike, and volatility is not going to stay as high as it is for long. I guess I don't know if the figure is 80 or 85% of the time that supposedly we're in contango, but the times we're in backwardation, I consider like contango and backwardation are sort of long-term things that will either decay or increase the value of ETPs, whereas the VIX movements are short term. And usually when we're in backwardation, the risk of a down move in the actual VIX is going to affect things more than the effects of backwardation, and that down move is going to come sometime pretty soon. That's why I'm very careful about being long when we're in backwardation.
Yeah, it could happen any day, any sort of news announcement that could come from the Fed or anybody else in charge, and that's what we saw in December. Powell got the message. we're not going to rate hike. We're going to take a pause. Yeah, so that kind of comes out of nowhere. And
now, do you think we've been in a bull market for a while. It's going to be a bear market at some point. Do you think these strategies still are applicable and hold water in a bear market, or do we shut down the strategies while it's a bear market and wait for the market to turn?
My strategies are designed to work in essentially any market, okay, whether it's bull or a bear market. And I have two different strategies. One is the VRP, and the other one is the VXX bias, which looks at the term structure. And they each have their own strengths and weaknesses. And I think, as anybody will tell you, there's no perfect strategy. Mm-hmm. Each of these strategies really struggle in certain market conditions. And the way I've tried to design these is that they both won't fail at the same time. Hmm. So I essentially trade only when the two indicators agree on what to do. If they don't agree, I move to cash and I just wait for a better setup where they agree. And I'm in cash probably about 30% of the time. That's when they disagree. And the other times are when they both tell you that the conditions are right to either be long volatility or short volatility. As we went through last year, before that, 2016, 2017, we had maybe one long VXX trade. Everything else was short volatility. It was very clear there was an environment to short volatility. And last year, things really changed. We started in January. We got a VXX buy signal for one of the indicators, and that was followed by the other one in February. And I think all in all, last year we had maybe roughly six buy signals for VXX.
Wow.
Which is a pretty dramatic shift.
Yeah.
From the previous years. You go from 0 to 6. This year we had one long VXX trade, and I guess that was last week. In fact, we were kind of fooled. We bought Wednesday or Thursday last week and kind of took a beating on Friday. But yeah, I think we're gonna start to see a little bit more VXX trades, a little bit less short vol trades, at least for the time being. And now that you mention it, one thing that I find to be really interesting, and a scenario that I think could be really interesting, is we have this relationship of VIX and the S&P 500 sort of in this inverse correlation. Mm-hmm. And that's really not a guarantee, and people should be aware of that. If we have some weird situation where you have some devaluation of the dollar and it drives the equities market sharply higher to the point where it sort of gets parabolic, you could actually see backwardation where VIX is high, it's higher than VIX futures, and you could actually have VXX do very well at the same time as the S&P 500 doing very well. So the precedent for that essentially is we saw that in Japan, 2014 timeframe. There was a parabolic rise when there was a lot of quantitative easing from the Bank of Japan, and they were in backwardation for something like 6 months. Don't quote me on that because I haven't looked in that data for years, but it's one of these things that just, as I talk to you, we talk about bear and bull markets. it's only half relevant because you still want to look at the VIX futures no matter what the S&P 500 is doing. If you want to be short the S&P 500, be short the S&P 500. If you want to be short the S&P 500, don't buy VXX. It's two different things, and I don't think people should equate those two. So just something to keep in mind as well. But yeah, I think nobody really knows what the equity market's going to do. There's just so many international factors, central bank factors, obviously earnings play into that. But on the surface, we've had a long bull market in equities. We've had a long bull market in bonds. It seems logical that those might pull back, and we would see a volatility spike, but we don't really know. I think that's sort of the mystery that keeps us all up at night or thinking about new ways to look at it.
Yeah, totally. If we knew, we would be in Hawaii retired somewhere, I guess.
Exactly.
So do you what about the V stocks? Do you think there's opportunities to trade volatility in the European stocks that are accessible to us and the as people in the US with our broker terms here?
Yeah. I think that is I don't currently do it. Yes, there's a stocks 50 index. The V stocks, for those that don't know, is VSTOXX. That's the implied volatility of the stocks 50, which is the European, essentially Europe's Dow equivalent. And I would love to try to diversify into those. They actually have 2 ETFs that are available on most brokerages. And I'm going to say most because some of them may have gone away after the Volmageddon event drove a lot of brokers to restrict shorting volatility. So there's two ticker symbols to look at. One is EXIV, and the other one is EVIX, VIX. It's basically Europe's equivalent to XIV and VXX. And one of the nice things, depending on how you look at it, it could be a bad thing. EXIV is an inverse of the V stocks front months, and it's a -1 leveraged inverse. So it's just like the old XIV was, not the new reduced leverage for SVXY, which is half leverage.
Right.
So that's actually a pretty cool thing that you can, a cool way where you can actually get full inverse volatility exposure to Europe's volatility. The volume on there is incredibly light. Last I checked, which was maybe 6 months ago, but
I'm just looking at it now. Yeah.
I don't know how bad it is. I don't even know if they're.
It shows 1,800 shares right now on the day. Yeah, so that's real small.
Yeah. But one of the nice things is, just like XIV, you can. I mean, it's a pass through to buy into VIX futures or V stocks futures in this case. So you can place a limit order, and you can probably get it pushed through pretty easily because it's going to execute the V stocks futures on your behalf, or through the authorized participants. Probably a more correct way to say that. But it's not like a stock that's only trading a few thousand shares per day. It should have pretty good liquidity, but I would definitely have people do limit orders and do some tests first to see how it behaves, make sure they can get in and get out.
Yeah, I understand what you're saying. It's not based on supply and demand for EXIV. It's based on the futures, and so probably if you put a bid mid-market, you're going to get filled pretty close to mid-market. Just because there's a wide market doesn't mean you can't get filled in between. Yeah. Right now, it's showing 22 cents wide.
So. Yeah. But even if it's a wide bid ask, it might be worth it. And let me just throw some numbers at you as I pull up these charts. If you look at SVXY as it rallied from late December up until now, it's went from 40 to 52. So, over a 25% gain. And because the leverage was there for EXIV, that rallied from 19 back in December, and it's now at 31. So over a 50% gain. They trade almost identically in terms of day to day, just a larger magnitude on the Europe version. And that doesn't have to be the case, by the way. That's just happens to be that Europe's stock market and our stock market are currently highly correlated.
And I noticed you did tweet out recently how brokerages are beginning to pick up SVXY again and allow people access to it. Do you think that we will get access to more leveraged VIX products in the future again? I mean, it kind of it really bummed me out when UVXY got nerfed, as they say in the gaming world, because I was long put spreads and I got crushed. But beyond that, I liked having the ability to have leveraged VIX stuff, and I understand it's a lot of function of the clearing firms and banks that just don't want to take on the extra risk. But do you think we'll see more products come out in the future that have sort of more leverage, or get back to where we were?
Yeah, I think there's a sweet spot. I think maybe around 0.7, 0.75 leverage. Mm-hmm. And that's just me knowing that the full -1 leverage is sort of a disaster waiting to happen. And it happened in February. And I don't think February is just a one-off event. I think, we could have a flash crash. We could have a flash crash like 2010. We could have a 1987 event. We could have anything can happen in the stock market. And I think when you have that full -1x leverage, it's probably going to blow up at some point. With -5, I think you reduce your chances quite a bit, but it's just a less interesting product. So I certainly hope so. I've been watching the news about some of the Bitcoin ETFs that they are approving, and if they are willing to approve ETF for a product that has declined 90%, I don't know what the number is, over the past year.
Yeah, exactly. Good point. Exactly.
I think there's more speculation in the Bitcoin ETFs than there would be in a volatility. That's more understood, at least in how it moves. Whereas Bitcoin is just sort of a mystery, completely speculation product.
It's amazing how many people went all in on Bitcoin. I mean, and there's a lot of people I know that were like in the options industry and stuff that just, sold everything to get into the, Bitcoin's the future. We're changing the world. It sounded like Theranos commercial or something. We're changing the world, and it really hasn't panned out completely. And I kick myself because a couple of my friends did buy Bitcoin for $3,000 and sell it for $15,000, but that seems to be more the exception than the rule at this point.
Yeah, you really have to be the early adopter, and once it's making a bunch of headlines, it's probably time to get out. And I think, unfortunately, everybody has their own news sources, so being an early adopter is sort of relative and depends on what your news source is. But yeah, I didn't do as well as I would like in Bitcoin, but I essentially cashed out of it with a small profit, and I guess was lucky to have that when I look back.
So does this volatility website and stuff, is this like your main gig, or do you have another gig that you have? That's part one of my question. And part two is, do you trade other stuff besides the VIX?
So I have two gigs. One is the website, which is designed to help individual investors, self-directed investors. And my other gig is managing essentially a private investment fund, which also focuses on volatility. It's the Switchback Dynamic Volatility Fund, and it is designed to cater towards qualified investors, meaning they have over $2.5 million in assets, and they want exposure specifically to volatility as an asset. And similar to what I offer on the website, the fund is dynamically allocated to either buy volatility or sell volatility. So those are the two gigs.
Nice. Well, it seems like you've carved a nice little niche out for yourself.
Yeah, it's certainly been interesting, and one of the things that I'm probably most proud of is, I have a small number of subscribers, and we went through a very rough year last year. We went through February. I like to at least think that I don't have numbers, but there's probably tens of millions of dollars of losses that I probably saved people from between my blog and my subscription, of saying, hey, don't short volatility as your only, don't think it's a sure thing. You got to pay attention to what's going on in the market. So am pleased that I have been able to help quite a few people. Would be happy to help some more if they are willing to be helped. But at the end of the day, and it's always you make your own decisions for investments, and all we can do is sort of put the information out there and help the best we can.
Yeah, that's a great point. And I had a lot of viewers that got really hurt in the Vomageddon, and I had to kind of back up. And now pretty much every broadcast I make, I try to explain to people, look, this is not an all-in proposition. I have my long-term savings are diversified in a spot that has, is not leveraged and has a bunch of risk associated with it, and yours should be too. Because I found out, after the fact, that there were a bunch of people who were like margin long XIV, and that was their whole strategy in life, and that's where all their money was. And yeah, they made some money initially, but they were never taking it off the table. And I know it's a complicated process to say, okay, exactly how much do you want to take off the table in like XIV or something. But I was shocked to find out the risk people had on. And I realized that I'd only been talking about this volatility trade as if that was the only trade I did. But for me, I had quote unquote more conservative investments for long-term holdings. And, and this was just kind of like a fun thing that was riskier that I was engaged in. So it's great to, it's really important, I think, to tell people, look, don't go all in on anything.
Yeah. I generally tell people to allocate maybe 10% at most towards a volatility strategy.
Right.
I could see going as high as 20, but anything can happen. And even if you do well for a while, as you said, if things go wrong and you do lose 20%, that would be probably a pretty big negative impact for most people.
Well, I mean, it's, when we step back and we think, when we talk about most people, the average American thinks that the way to make $100,000 in life is to buy scratch tickets at the gas station. And so we're actually, there's obviously more sophisticated people that are sort of watching what we're doing, but we have to realize that there's a lack of education for people out there in finance. And sometimes, we jump ahead to sophisticated strategies without acknowledging that just someone learning how to save money every paycheck is a huge part for a lot of people in America right now.
Yeah. Yeah, it's a slow and steady. It's saving. It's putting stuff in retirement accounts and putting it in indexed funds. It's certainly one approach, and hopefully that works well for most people. I guess all you can do is adopt a strategy that makes sense, that you're comfortable with, and go from there.
Yeah. All right. Well, listen. We've given people a lot to think about, I think, in a short period of time, and I appreciate you spending a little time with me. It's interesting because a lot of the strategies that I talk about are options related, whereas your strategies are based on the ETF. So it's definitely a difference between what you and I are focused on. So I think that gives people more, a breadth of different ideas. So that's good.
Great. Well, thanks for having me.
All right. Well, thanks for your time. And folks, you can look. There's links in the description to Jay's website and information. Please check it out. Thanks for listening to us today. Thank you, Jay, once again for giving us a little bit of your time, and we will see you next time on the Short Vol Show. See you later, folks. Thanks.